Hi, I'm James Robinson, and this is my stock pick of the week. This is part 3 on my series on the company SMP, Standard Motor Products. Today we're going to talk about the company's balance sheet. I think people really overlook the balance sheet of companies because they're so interested in earnings. The balance sheet, though, is where things can get hidden that can cause future problems. If a company has a lot of debt, that means they have a lot of money they have to pay in interest, and they have to pay that interest whether times are good or bad. Obviously, it gets hidden during the good times because there's plenty of money to pay the interest, but it can destroy a company when times get bad. Also, there can be assets hidden on the balance sheet that you can find through reading annual reports that will give you greater degrees of comfort when you're buying a stock, so that when the bad time comes, you know that the company is able to survive. So I pay a lot of attention to the balance sheet, and I don't think many people do, which I think is a mistake. So the first thing that I look at on the balance sheet is cash and marketable securities. Why do I look at that? Well, that's how much money the company has on hand for an emergency. It's how much money the company has to pay off debt. It's the ability to pay off dividends. Also gives me a sense of the management. If there's too much cash on hand, then the company's hoarding money, and they should be returning money to me, the shareholder. And if there's not enough cash on hand, then the company can't survive the bad times. So since 2013, this company's gone from $6 million in cash and marketable securities to, call it $22 million. So it's more than tripled the amount of cash on hand. It's been pretty constant. It has gone up faster than earnings. So long story short, cash and marketable securities in the company is pretty strong. I think the company's in good shape. I also don't think they're hoarding too much money. Having said that, there's more to it than just cash and marketable securities. So there's another category called investments and advances, which if you look at this company since 2012, it's actually saved a tremendous amount of money in investments and advances. It's gone from basically $0 in investments and advances to almost like $43 million in investments and advances. That's made the total reserves, which I define as cash equivalents, marketable securities, as well as investments and advances. The total of those two numbers has gone up to $60 million. So in 2012, the company had about 12 million. Today it has 60 million. So it's gone up 500% roughly in 8 or 9 years. That's pretty spectacular. That's one of the reasons why, even though when you look at this company operationally, it's not exceptional, it's what they're doing with those profits that is really giving me reason to really like this company and invest in it. The next thing I look at is current assets and current liabilities. So just again, to summarize, a current asset is an asset that shows up on the balance sheet that the company either has or will have in the next 12 months. A current liability is an obligation the company either has or will have to pay, either has to pay currently or will have to pay in the next 12 months. And so when you look at the current assets and current liabilities, that's sort of the company's ability to take care of business in the short term, right? If the number was current assets were less than current liabilities, that would mean that in the short term, if they may not have the money to pay their bills. If it's too high, the amount of current assets is too high relative to current income, again, that's an indication the management is hoarding money, and I'd want to know why they were doing that. What you can see here is that the difference between these numbers has been pretty constant. It's been pretty consistent. As the current liabilities have gone up, which they constantly do in a company that's growing, the current assets have gone up proportionately and not disproportionately. So I like this in a company. This is one of the things that I really find interesting. I think the management, the CFO in this company is doing a very, very good job. Current liabilities we'll talk about in depth, but long story short, a company's current liabilities are going to increase over time if the company's profits are increasing, because current liabilities are things like payroll. They're things like rent for your facilities. And as you grow, you're going to have more payroll and you're going to have more rents for facilities, for example. So I'm not really worried that even though current liability is a debt or a debt obligation, I'm not really worried that that's increasing because it's sort of supposed to. So current ratio is the ratio of current assets to current liabilities. It's a quick way of looking at how strong and safe your company is. It's interesting because this is one of those things where when you get too high a current ratio, that's an indication the company is not intelligently using its reserves or its cash or not returning money to the shareholders. So you can see this company is flat in the middle between an average company and a great company. In theory would be a company in the top 10 in current ratio, but in reality, if your current ratio is too high, it just means you're hoarding cash. So it's kind of this fine line that I look at when I'm analyzing these companies and saying, well, the current ratio, where is it in relation to their current obligations and in relation to their business growth and a number of other factors. It's not simply good enough to say, hey, if you're more is better. It's not necessarily more is better. It's appropriate is better. And you have to really look at the company to try and figure out what is appropriate in terms of current ratio. But with this company, again, we've seen that the current ratio has been pretty consistent since 2009. It's gone up slightly. That's not a problem. It's never reached the top 25% of companies. It's never got 2 out of line. It's never got above 3. So I'm pretty comfortable with it. So this is looking at the company's debt analysis. This is the total current liabilities and the total long-term debt. So the blue line is total current liabilities. Again, that's something that's going to go up if your company is growing. It just works out that you have to spend more money on a whole bunch of costs that have to be paid in the next 12 months that are defined as current liabilities. And the fact that they're going up isn't that important. If the income is going up faster than your current liabilities, you're actually getting more efficient even though you're packing on these current liabilities, which is what's happening with this company. The other thing that I look at, of course, is debt. If you look at this company's debt in 2001, they had $200 million in debt. In 2008, they paid it all off. That's pretty impressive. Took them 7 years. They then were debt-free until about 2019. So how do I feel about this company taking on debt in 2018 and 19? First of all, interest rates are so low. I'm not really that bothered by it. I also know that this company has bought several $100 million worth of other companies. And there are 2 things that might be happening here with this debt. One is that they've used debt to finance these purchases. I'm not really that upset about that because it's such a low percentage of the company's operating costs in terms of interest coverage. It might also be the case, by the way, that this debt was taken on when you buy the company. So if you have no debt, but you buy a company with $100 million worth of debt, then you now have $100 million worth of debt, and you can choose to pay that off. But if the interest rates are so low on it, you might not pay it off. And so it might be that this company has actually borrowed no money. They've just acquired this debt through purchases. I haven't researched it. And the reason I haven't researched it isn't because I don't care. It's because the amount of money involved is so low that it's not going to change my opinion either way. If this company's chosen to borrow the money to buy those other companies, fine. If this company has bought these companies that have some debt and it's going to take them some time to work it off, that's fine too. It is telling that from 2019 to 20, the debt did go down a little bit. So that means that they are generating enough cash flow that they're not continually taking on debt. So that's it for debt analysis. For this company, it's very, very strong. The next thing we look at is interest payments. And we look at interest payments through 2 prisms. The first prism is what exactly is happening with interest payments, just in a vacuum. So you can see here that the interest payments have been 0 until about 2009, and they shot up to about $7 million. They dropped down, they've gone up a little bit, not very much. But long story short, it's such a small percentage of the company's operating costs that I'm not really that worried about it. The general trend from 2010 to now is it's down. You know, we're paying half of what we were paying in 2010 in interest payments, and that's despite the fact that we're making more money. So I'm not really worried about it. I'm not worried about it in terms of scale, and I'm not worried about it in terms of direction, right? The next thing that I look at is interest expense relative to interest income. There's not much interest income, so it doesn't really offset that very much. So we don't worry about that. But there are companies where that's a big factor. A company might be taking on debt, but they're also investing that money intelligently, or they're investing money intelligently rather than paying down debt, and it's creating this offset against interest expense. So again, this isn't a problem with this company. The debt's low enough, but interest income isn't really offsetting that. Interest coverage ratio is another quick way of looking at things. What we're really saying here is how much money did the company make and how much money does the company have to pay in interest, and what's the ratio between those 2 numbers. And you like to see an interest coverage ratio of 2 or 3, 4 times, something like that. You can see this company is, ridiculously high relative to that. At one point, the company had 70 times interest coverage ratio. So obviously, if you have no debt, your interest coverage ratio would be infinite. If you had way too much debt, then you'd have a negative interest coverage ratio, which means you didn't make enough money to pay your debts. So the higher, the better. This is one of those things where higher is better. And, in this case, we currently have about 52 times the income we need to pay the interest. Basically means interest is an irrelevant factor in this company. Things have to get so bad and change so dramatically for interest to be a problem that for a company this stable, that's this established, that's not a high-tech company, we just have no concerns about debt for this company, which again is one of the reasons why I've suggested you should buy it. The operations are pretty good, but not spectacular. But the debt and balance sheet of this company are a 10, and you're going to see the wealth creation of this company are very, very good. And those 2 things together, combined with a business that I think is a niche business, is the reason why I'm suggesting you should buy this stock. Year's income to pay off long-term debt. So this is really looking at one of the ways that I try and, just as a quick back of the napkin understanding of a company's debt situation, is say if a company decided to make it a goal to pay off the debt, how long would that take? If it takes, more than a couple of years, 3, 4, 5 years, that starts to mean to me the company has too much debt. I don't really like companies that do that. You can see this company, at one point it was negative. It wasn't making enough money to pay off its debt. That obviously was 20 years ago and isn't a problem anymore. Since about 2008, this company has had no problem paying off its debt, and certainly much less than a year to pay off its debt for this company. So this company is, again, the balance sheet of this company is fantastic. What I'm looking at here is the amount of interest expense that a company has relative to its operating income. So operating income, again, is you take the total revenue, you subtract out the cost of goods sold, which is the cost to manufacture your products, and then you're left with operating income. And I want to know what percentage of that operating income, and that operating income is money that's used to pay for, we talk about the 4 taxes and operations, right? So it's used to pay research and development, it's used to pay sales and general administrative costs. It's used to pay for your facility operating costs, those kinds of things. It's used, and so how much of that pool of money is being gobbled up to pay the bank, right? That's what I'm looking at. I like to see that any company be paying less than 15% of that pool of money to the bank in form of interest. You can see in this company, it's never really been much above 4%. So this company is in a very, very stable position. And interest expense as a percentage of operating income is very, very solid for this company. Debt to equity ratio. So this looks at, the company has equity. Equity is defined as you take a company's total assets, you subtract the company's total debts, and the difference is the equity. So we like to know what the debt is in relation to the equity. Good companies will have, the lower the debt to equity ratio you get, the better the company is. A bad company would have something like maybe 4 times the debt they have to equity, or 5 or 6 times the debt. That becomes sort of uninvestable to me, unless there's a very specific and great set of circumstances. To be in the top 10% of companies, you want to be less than 1, less than half of 1 really. And you can see that this company is in that ratio. It's in the top 10% of companies in terms of debt to equity ratio. That's really all you need to know. This company's debt as relation to equity is really not significant or important. So that pretty much does it for the balance sheet for SMP. As you can tell, the balance sheet is one of the very strong parts about this company. I have no real concern this company going out of business. I think this company does a very good job of managing their debts, and what little there are, they seem to be doing a good job with their cash flow. And so it's one of the strong suits about this company, and one of the reasons why I would strongly suggest you consider buying it. Thank you for your time.